Welcome everyone. Thanks for joining me. We're right on time here at 12 noon Eastern, 9 a.m. Pacific, and we're going to go ahead and get started right on time. And I know there's a lot of people joining us as we speak. So also encourage you during the presentation to ask lots of questions. Use the question functionality, the chat functionality, and I will do my best to get to your questions as we move along. But we're going to talk about automated high probability options trading. We have a unique solution and strategy. And we're going to look at pre-built option spreads with automation. We have a special indicator to help you automate your risk and profit management. We're going to talk about hedging your portfolio as well as making speculative directional trades and non-directional trades. And we have one-touch trade alerts and something you've never seen before. I can almost assure you of that. So thanks to Investor Expos for having me here. Thanks to Anna as well, who actually is Ukrainian. So I'm sure you can all imagine she's going through a very, very challenging time right now, but I just spoke with her and she's okay. So far, so good. So with that said, remember, we're speculating and we're trying to make money as prices move up, down, and sideways. So we're assuming risk. There's always risk when you try to make money and profit. And with that said, take a moment, read the risk disclosure. It is important. Keep in mind, all funds committed should be risk capital, and past performance is no guarantee of future results. And if you notice in the webcam, I'm not always looking at the camera. That's because there's multiple monitors I have to look at, so bear with me. Remember, we're going to look at trading stock index options, and we'll use proprietary automation. And the whole idea is you want to avoid this scenario here where you're struggling with your trades. You want to be more like this automated robot. And who are we? We are Altivest since 1997. We've been trading futures and options, decades of experience, millions of contracts traded along the way. We're registered with the CFTC, member of the NFA. We're located in California. Those are the agencies that oversee our industry. Traded millions of contracts along the way. Sometimes maybe you see us getting published on various websites. Here we are on MarketWatch, getting quoted here, talking a little bit about gold prices. Could be anything really, just happened to be gold on that day. But the whole idea is use our experience. Don't try to figure it out by yourself in your basement like the mad scientist down there, the loner. And we're gonna look at trading solutions built with decades of experience from industry veterans. And a little bit about myself, I'm Erik Gebhard, been doing this about 30 years now. Since 1991, I've had my Series 3 license. I have a BS in Business Administration from the University of Southern California. And maybe you've seen some of our presentations, various webinars in the past. We used to do a lot of in-person events, but of course the pandemic changed that. Hopefully we'll get back to the other soon. Began in mutual funds and annuities in the securities industry with my securities licenses, 6 and 63 licenses, mutual funds and variable annuities and so forth. And I currently have my Series 3 commodities license as well as my Series 65 investment advisor license. So the introductions are out of the way. I'll go ahead and turn off the webcam. That way you have a little more room on your screen. Okay. And let's just talk real quickly. We all know what's happening, but markets are definitely in correction territory. In November, you've got all the markets making their highs, you know, the Russell, and Bitcoin, and NASDAQ, you name it. And here's what we look like now, dropping significantly, almost in what they call bear market territory. Here's even Bitcoin. These are from last night. I took these images, so a little bit different. I think Bitcoin's down today. NASDAQ's down even more today as well. S&P. So you all know what's happening. But what if you were in a hedge fund? You know, hedge funds are supposed to be able to go long and short and be able to avoid these types of drawdowns and these types of losses. Look at this. Prime broker data says average hedge funds down 9% year to date. I think it's even worse. That's from a couple of couple weeks ago. And Wall Street Journal talks about growth hedge funds suffering their worst rout in years, adding to the 2021 losses from last year. So perhaps there's really no safety in hedge funds either. This is interesting. This just shows you here that popular hedge fund long positions suffered their worst 12-month return relative to the S&P. So you can see they're underperforming the S&P 500. And we're definitely in an economic slowdown. Oil prices always have preceded recessions when prices of oil move up. 12 recessions, 8 were followed by major oil price shocks, and 3 occurred immediately following modest or notable price run-ups. So is correlation causation? Probably. Oil prices are skyrocketing. Here's what they look like. And of course, you know what the geopolitical landscape is now. Prices were even moving higher. You can see back here in December, January, moving higher regardless of what's happening overseas in Europe and with Russia and so forth in Ukraine. Inflation, gas prices, I just saw gas well over $6 here. In the Bay Area, average price over $5. Here's a consumer price index came out today. We're at record 40-year highs. New 40-year high on inflation, almost 8% now. Here's what it looks like here. Here's where we are. Here's some of the records back here in the 70s. So just pointing out, I think probably what you're almost aware of, almost 8% here, that headline CPI. Cost of housing dramatically higher. Producer price index also soaring. So that's basically inflation, and it means really the CPI and the PPI don't look like they're moderating anytime soon, and that keeps pressure on the Fed to raise rates. But there's also an economic slowdown going on. So that's going to be interesting. We won't go too deep into this, but there's something called the 10-year, 2-year yield curve. Simply, what's the 10-year yield versus the 2-year yield, subtract the difference. But as it flattens or approaches zero or even goes negative, it's more likely that stocks will sell off, leading to a recession, or it's a sign of a recession, cause and effect. But here's the yield curve right now. So we're dropping and dropping and getting very close to zero. And here's another comment here, bracing for high oil prices. The Fed may be forced to raise rates while going into a recession. That's, of course, raising rates is an attempt to stave off inflation. But what happens when they raise rates? When they raise rates, here, the economic growth is already decelerating. And if the Fed does what the market thinks it will, stock market volatility will expand, stock prices plunge. So the markets are anticipating the Fed is going to raise rates over 6 times by December of this 2022. And the Fed, it says here, basically they're always late. Their MO is to mistime things. Economic growth beginning to slow. Powell is now going to repeat the mistake he made in Q4 of 2018, in which the S&P returned negative 4%. And this is interesting too. We talked about it briefly. The Fed rate hikes precede recessions. So look at this real quickly. The last 10 recessions preceded by higher short-term rates. In the Fed's policy process, recurrent pattern for 70 years. Here's what's happening. The Fed is too easy. They have loose monetary policy, which is what they've been doing for years now. Then that begets energy inflation, which is what we have now. And that tends to creep into the broader headline inflation. Of course, that's occurring now. Then they begin to tighten their policy, and then they prick the energy inflation bubble that they created. But in so doing, the last 10 for 10 times has caused a recession. So economic data decelerating. Atlanta Fed cuts the Q1 GDP to 0%. So they're projecting 0% growth. Just a graph here of their projections down here at 0. Job openings at record highs. And of course, you know what's happening geopolitically. One of these analysts here is suggesting the financial markets are going to keep suffering under this, what he calls a war cycle. He's looking at the Dow, the next leg down to 15,000. And we shall see, but even then he's thinking it could even get down to 5,000. So with that in mind, how do you trade in such an environment? And I want you all to kind of go through this. We're going to look at 3 of the common barriers, and I think we can all relate to these. So feel free to chime in and let me know which ones you kind of struggle with the most. But day trading, first of all, it's not easy, folks, and there's less than a 1% success rate. Is that true? Well, there's some economic studies that say it is true. Charles Schwab analyzed their active trading accounts over a 6-year period of time. Traders substantially underperformed a simple low-cost index fund. They had the worst returns, the ones that traded the most. Here's a Taiwan study. Over 15 years, less than 1% of day traders consistently beat the market. And here's out of Brazil, 3% of day traders made money. Less than 1% made more than the minimum wage. So the point is, if you're day trading and making it work, more power to you. But it's not that easy, folks. And social media sometimes gives us the impression that everyone's making a fortune, but really that's just you can't. First of all, you can't believe whatever you're hearing on social media. But being popular means you never criticize stocks. Here's a kid that says he found a glitch in the stock market, so you're supposed to buy whatever he's selling. And another kid here, he's 18 years old. He says you can trade with 500 times leverage. So I don't know if that sounds like a good idea to you, but not a good idea, folks. So that's just called selling a story or narrative trading. The bulls like to always sell a story, and the old here Wall Street looking veteran guy reading a fairy tale book about the stock market. So even if you're trading, are you beating the market? Can you do better than just passively investing within an index fund? Here's another economist, Mark Skousen. He ran this study here, kind of a hypothetical thing. You have these 100 what they called monkey portfolios, just basically random portfolios, and 96 of them outperformed the benchmark index by 1.7% per year. So perhaps there is your best money manager or hedge fund trader. And emotions. When you're trading, you got to control your emotions, folks, but it's not that easy. It can be expensive trying to convince the markets that you are correct. That's a great quote there. You don't want to end up with this here on your tombstone, arguing against the market. Prices never lie, folks. We're only wrong. Prices aren't. There's a lot of noise in the markets that it contributes to all the emotions. You've got, bullish pundits, bearish pundits. You've got everyone on business channels, news, whatever, making all their comments and opinions heard. It puts us on this roller coaster, this cycle of market emotions. You're optimistic, euphoric when your account's doing great, and you get despondent when you're doing poorly. Then all of a sudden, over time, you become optimistic again. So you want to stay off of that roller coaster. And the problem is our worst enemy is us. And I think that's true. Motley Fool suggests there's basically these 3 biases: confirmation, anchoring, and recency bias. And I think we could all agree, this kind of would sum it all up here, really. So how many times have, we've done well with something thinking that we're a genius, and that's just kind of a scenario in which you want to avoid because you get overconfident, you make some same moves in the future, and they backfire. But anyway, remember, algos have no emotion, and they're dominating the landscape. What percentage of trading is algo trading? 90%. JP Morgan estimates that 90% is systematic trading. So 90% of the volume in the US equity markets. That's a lot. So when you're trading on your app or at your desk or whatever it may be, your competition is not some other person at their desk. It's basically an institutional machine of some kind. Robots are outwitting their humans. That makes no sense, or it makes sense is what I should say. Revolutionary trading. So here we are in the era of the computer, and here's where we were. So that's what it used to look like. And now this is our competition, folks. Emotion-free, automation, built-in risk controls. Can you easily use algo-driven option spreads in your portfolio for up, sideways, and down markets? So that's what we're going to jump into in our demo here in just a minute. And we're going to be looking at trading futures index options, not individual stock options. And the three reasons: first of all, an index option is less volatile, or an index market, I should say. A stock index might make a 3% move in a day, and that's a pretty big move. Even yesterday's move, the big rally, wasn't even 3%. Individual stocks could move 10, 20, 50% in a day. It happens all the time. There are strategies for any market direction with portfolio hedging, directional strategies. We'll show you how to use that as well. And you can just look at one or two markets, not track over thousands of stocks and ETFs. So various advantages, we'll jump into that in just a second. But first of all, let's look at insurance companies. How can we be this guy here? How can we be an insurance company and collect premiums? Well, we need to be able to essentially manage risk. So we're selling time. We need to insure ourselves against risk. We need to be consistent and patient. And then we'll look at probabilities and simply math. That's all we're looking at. Long-term probabilities, statistics, actuarials. That's how insurance companies do it. And we can look at some math as well and have computers do the work for us. So casinos do the same thing, folks. I'm sure you're well aware. Every game you play at a casino, the casino has a big advantage. If you play roulette here, that house edge is 5.26%. So they'll gladly have you play roulette for as long as you want. In fact, the longer you play, the more likely it is they're going to get that full house edge or advantage out of you. And they'll do this even though every now and then they're going to pay you some winnings. But in the long run, you're going to lose. That's just what the math says. So here's the, this was interesting. A couple months ago, I saw this. Nevada casinos report their 9th straight month of a 1 billion house winnings, which is a record. So how do you be the house? How do you be the casino or the insurance company for those higher probability outcomes? So we're going to look at some options trading with some strategies where we're going to collect premiums by selling options. You collect the premium, and we're consistent and we're patient. We have to manage our risk. We'll have to expect to have losers, of course. And of course, manage reward, just as important. Don't be greedy, but you need the proper tool to make this happen. You can't just decide I'm going to do this one day, because quite literally there are millions of combinations of options trades. So we're looking for base hits, not swinging for home runs here. These are short option strategies for non-directional, bullish, or bearish strategies, or conditions, I should say. And we'll look at higher probability outcomes with predetermined risk. So we're looking at credit spreads. They may be non-directional in nature. I'll show you here an example. Don't worry about this chart if you don't understand it right now, but here's an example where you're at this level here, you place a trade. This is the upper boundary. Here's the lower boundary, and you have this wide margin of error here in which the trade can work out favorably for you. So you look for the market to stay in this wide range. You can see in this case it did. But first of all, a couple things about the Greeks. If you trade, okay, and I think I clicked my mute by mistake, so hopefully I'm back on. I think I am, yep. So we're gonna look at delta. That's the approximate probability of expiring in the money. And let's give you some ideas here on how that works. If an option delta is 0.25, there's a 25% chance of expiring in the money, 75% chance of expiring worthless. Remember, delta is always moving with price and time, so it's just fluctuating, just like markets do. And it is not the probability of a winning trade, so keep that in mind as well. And then there is theta, that's sensitivity to time. Remember, options have limited life, and theta is a negative number and it equals 1 day of time decay. So if an option premium is at 10 and theta is negative 0.05, then the next day the premium is 9.95, and the next day after that 9.90, and so forth. So just graphically, here's kind of what it looks like. The value of your premium will just start to lose more and more value here as it approaches time zero, basically all things remaining equal. So options have limited life. So here's an example of selling a call spread. Here's the call spread here represented by the red and blue lines. Here's the underlying market moving up and down and with an upwards bias here. But in this case, you sold the 45.50 call, that's the red line, and you received 4.5 points for that, for selling this option here. You simultaneously bought the 45.70 call and you paid 2.25, but the net result is you collect 2.25 points, $112.50, minus your commission, and you look for the market to stay basically below this threshold, generally speaking. And we'll go through some examples. Here's selling a put spread, just the opposite. Here's the put spread that you're selling. You receive 3 points for selling the 36.60 put, but you buy a 36.40 put to hedge, and you pay $1 for that insurance. The net result there, $100 in this example. But remember, it's important we're not doing naked options. You don't want to be uncovered. Your maximum risk is always capped in advance. That's what you call a covered option spread. No naked options trading. If you're doing it and going short options without being covered, it might work for a while and even a long while, but I can promise you when it doesn't work, it's going to end up giving everything back and then some. You want to avoid that like the plague. And also, you're going to have margin calls and all sorts of problems with your trading if you're trading naked options. So just don't do it. Only trade covered options. So here's an iron condor spread. It's kind of an odd name, sort of the name given to it just because of the way it looks on the graph when you graph out the P&L. But we're not going to worry about that right now. And it's really simple. It's just a combination of the put and the call spread that we just saw. So you sell a call spread, collect the premium, sell a put spread, collect the premium. You do it simultaneously. And in this case, you look for prices to stay within that range between the calls and the puts. Now here's a really oddball strategy, or some people have called it weird, but people absolutely love it. Something we kind of came up with years ago and then developed our solution here, our software, and we're going to show you that in just a second. But this is called the Dragonfly. It's for income generation, just like the Condor or any other kind of credit spread. Has 6 legs, and it's a variation on a Condor. And here's what it looks like, folks. And let me run you through an example. Let's look at the calls first. You sell 4 of these calls. That's the red line, 40/60s. You buy 3 further out of the money calls and then 1 closer to the money call. Want to point out the one that you buy here in this case is 50 points closer to the money compared to the 4 that you sold. And that will create a whole different dynamic because you own this call and it's going to lose value more slowly and it will gain value more quickly if the market's moving closer and closer to the upper boundary here. And you have the same structure on the bottom. You sell 4 puts, buy 3 further out, and then 1 closer to the money. So same structure for the calls and the puts. And you'll see again, the puts that you buy are 50 points. The one that you buy here is 50 points closer to the money than the 4 you sell. And I'll explain to you in just a second how you can choose all these strikes. In fact, you don't have to do any of the work. I'll show you that. And here's a unique strategy. We call it a bear hedge. I'll get to that in a second, but this is the half of the Dragonfly. I thought I'd throw this in there real quickly. So you don't have to do the full Dragonfly. You can simply do just the call side of a trade, and that would be called a half Dragonfly call spread. And of course, you could do the half Dragonfly put spread if you wanted. So in this case, the trade would work out well in really any circumstance other than a roaring bull market. And then here's the bear hedge I just mentioned. Let's look at the graph. It's easier to explain that way. Quite simply put, you sell an out of the money call spread and you take the money you collect for that and you buy an out of the money put spread. And oftentimes you can do this for 0 cost, even money as they call it. So here's a situation where if the market's going sideways, and the trades expire, then there's really no loss on the trade. If it goes sideways and starts to drop, then these puts can gain in value, and the trade can actually become more and more profitable. And again, the only way you get hurt on this is if the market runs up, in this case, dramatically higher very, very quickly. But how do you even know where to begin in terms of, which markets you're trading, what strategy to apply, what strike prices, at what price, what's the right value, what's the right timing, what expirations, how do you manage the trade once you have it, what's your risk, what's your reward? So that's kind of the question we get all the time, but we've got the answer. It's called Theta Trader, and we're going to show you how this works with our pre-built option spreads, our proprietary algo creating Theta Trades, advanced strategy automation, absolutely bull bear, flat market conditions. Actually, there's some of our, these are pictures I took actually, a lot of the pictures you've seen. These are S&P 500 floor brokers that used to work with us in the trading pit. Anyway, that was part of our staff down there. So we had automated risk and profit tracking. We're going to talk about that in just a second. So simple, effective option spreads with profit and risk management. And now is the time I'm going to switch gears here. And we're going to jump into the demo. Just takes me a moment to switch over. Okay, you are all looking at my dashboard right now. So this is our Theta Trader dashboard. I'll explain this here. You'll see this section here, it's called Theta Trades. And there are bullish strategies, pre-populated, bearish, already built out for you, and neutral or non-directional. And you'll see here the E-mini S&P 500, NASDAQ 100 mini, and the Russell 2000 mini. So these are the markets that Theta Trader primarily works with, and I'll show you why and what the advantages are. And before I drill down into this, you'll see these are open short positions in this account. This is a demo account. Of course, I do this for webinars. I use this account. Here's open long positions, any bought positions. Here's the account info. This is pulled directly from your AltaVest brokerage account. So to use Theta Trader, of course, it's our strategy or our solution and our technology. So you have an account with us at AltaVest, and you can see current quotes here. So, and you'll notice this is a demo account here for the webinars. We can take a look here. Since we looked at the condors and dragonflies, we'll go ahead and click on the condor. Let me expand this just a moment. And you can see the computer here has built out the trades for you. It's created these condor trades automatically, anywhere from 16 to 51 days till expiration. And you'll see the contract here is noted, and all the strike prices are pre-selected by the computer. And this is called your profit potential at expiration. This is your maximum potential, and then your targeted annualized return at expiration. I should make note, you'll never generate a 300% return with these trades. That's not the point of having this here. This is to compare one trade to another. Okay, so that's all these, that TAR figure is there for, to compare one trade to another. And clearly the trades with the shorter duration and days till expiration would have a higher annualized, projected annualized, but just use that to compare one trade to another. So what I'll do is we'll drill down on this one here, the April end of month expiration. And you can see here, this is the table describing all the details of the trade, and I'll explain that in just a second. But first, look at a graph. This gives you an overhead view. Here's the current price of the market, in this case, the E-mini S&P 500. And here's the call spread we're selling, and here's the put spread we're selling. We'll go back here, and you'll see 51 days till expiration. And this is the expiration date, settlement. I'm not going to go through everything. Here's the premium you're receiving, the put risk, call risk, commission, capital, cash required, profit potential at expiration, targeted return on cash, and then targeted annualized return. But here's the important portion of this table really is you can see the strikes are all pre-selected for you, and you'll notice that the delta is 9.96 on this put that you're selling. That means there's over a 90% probability that this put is going to expire out of the money and worthless. Now look at the call, 6.55. So over a 93% probability that this call will expire worthless. So that's the idea for these higher probability outcomes. And basically, you're taking $883 and your maximum potential here, $116. And people think, well, that's kind of backwards, isn't it? Well, not necessarily, because remember, you're looking at higher probability outcomes. So this is like lots of base hits in baseball, not grand slams. That's the whole idea for trading these credit spreads, something like a Condor in this example. And you can see here the algorithm already pre-populated to a sell. You're selling the Condor. In this case, it defaults to a quantity of 1. But we'll jump in here and do 5 of these. You can see the cash required moves up to 4,400, profit potential 582. But that's your maximum at expiration. But we don't ever want you to hold things till expiration, and I'll show you why and how that works. But here's your value here. You're trying to capture 2.75, and you can change that if you wanted, but quite frankly, most people using this do what the computer suggests, so to speak, and we'll go ahead and place that order. And there it is. You can see it just assumes you're filled in this demo account. Now we'll go back to the dashboard. Give it just a second here. Now I will also point out that there are dragonflies, and you can see today's Dragonfly Trades. There are 3 to choose from, and we'll go ahead and just choose this one. I usually choose the trades with the longest expiration for the webinars, just kind of randomly choose these every time I do this. And again, here's the graph. So here's the calls on the trade, here are the puts on the trade. And you'll notice, in fact, you can probably see it better. I'm not sure if you can see it that great here, but the 47.90 call, the one you buy, is 50 points closer to the money compared to the 4 that you sell. And the same with the put here, 3,500 put you buy is 50 points closer to the money compared to the 34.50s. And it doesn't always have to be 50 points. The algorithm will modify that a bit sometimes. It could be 60, I've seen 70, I've seen 30. So it just depends. But people sometimes ask, about that. And so I thought I'd make that comment. So you can see the cash required is 44.84, profit potential 516, targeted return on cash 11.5, targeted annualized return. Typically a Dragonfly will have a slightly lower, targeted return compared to a Condor. And again, that's simply because you pay money to buy this call and to buy this put. So you're just adding a little bit of extra insurance on the trade. And that can benefit you a lot compared to a Condor at times, and I'll show you in just a second. But you can see again the put here, a 9.88 delta. So the computer chose a delta here that has a over 90% probability of working out, and basically when you're selling it, expiring, and 6.84% delta here on the calls. So again, over 93% probability this option will expire worthless. it always defaults to a sell because you're selling the Dragonfly, collecting that premium. We'll do 2 of these, and we'll collect 12 points for each one, so over $1,000 profit potential there. And there it is, shows up as being filled. Now here is a really, really great feature for Theta Trader, something you've not seen before. And I've looked at what other people are doing with platforms, and I've never seen it. And we've had it for quite a few years now with Theta Trader, but we have something called a trade simulator, so we can go backwards in time and you can back test all these strategies here. So I've already loaded some just to save time. Let me squeeze this down. Let me show you how it works. In this case, on January 2 of 2020, let's assume we did this March Condor trade. That was one of the model trades that the computer had displayed. And you can use these tools here to play day by day. And you'll notice here, this is the first day of the trade. You can see the P&L on the trade here, just kind of a little bit negative. And you'll wonder what this color is. Well, that's called the risk thermal indicator. And I'll explain the colors in a minute, but green means good and do nothing. And you can see the price of the S&P here moving up and down. And you can see that this trade here is still a little bit red, a little bit negative. Let me move this just like that. You can see now the bottom. So theta decay is starting to work, but at the same time, the market's edging a little bit closer and closer to the upper boundary here. And now it starts to really drop. And then you see this orange. That means elevated risk, but still don't do anything. Okay, then yellow, slightly elevated risk. It goes to green again, goes to orange, and then it turns red. Red is too much risk, the trade's losing too much money, and get out. So this is something you can actually automate. So Theta Trader will track and monitor the position for you, and then if it triggers a red signal, it will automatically submit that order and close out the trade for you. So you can see here, this Condor was a loser. And let's remember that date was January 2. So I ran the simulation for a Dragonfly on January 2. So again, just to make it clear, if on January 2 you placed the March Condor trade, you ended up with a loss. But let's look what happens if you placed a Dragonfly on that same day. We'll compare the Dragonfly and the Condor. Now you see here, started turning a little bit profitable, a little bit negative, but it's all green, no good, nothing to do with it, really, is what I'm trying to say. Yellow, slightly elevated risk, but still nothing to do with it. And look at this. It gives a profit-taking signal. It turns blue. So when it turns blue, Theta Trader's tracking and monitoring, and then it will trigger an order to close out that position, and that's a profit-taking signal. So you can see here how the Dragonfly can act completely different than a Condor. The Condor never gave you a profit-taking signal, but the Dragonfly did. And again, that's because you own this call option here, and it changes the whole risk-reward dynamic dramatically. You can see the 34.30 call compared to the 34.70 calls that you sold. This one's 40 points closer to the money, and that made all the difference in that trade. Here's a April end of month Condor. I'll just go to the end here so we don't have to spend time playing it, although it is fun. But you can see this one here just kind of never gave you a signal one way or another until the very last day, and then it just basically ended up barely, you could say, working out. I mean, but kind of gave you a lot of grief here as it went closer and closer to this upper boundary. So that's the April end of month. But here's the April end of month Dragonfly. And this actually turned profitable on March 24, gave you a profit-taking signal. And on March 24, the Condor here, this trade, it was profitable, but you didn't have a profit-taking signal yet. So you can see once again, owning this closer to the money option, in this case a call, makes all the difference in the world. Here's a end of month August Condor. We'll just jump to the end. I don't remember what the result is on these, by the way. I'm just kind of doing this here. But so the Condor worked out well. So this gave a profit signal here on August 20. So that's fine. But look at the Dragonfly. If I can recall, this is a lot earlier. Yeah, so this gives you a profit-taking signal on August 4. So 2 weeks earlier, you're able to get out of this trade and move your money into another trade. Here's another trade here. It's a June end of month Condor. Okay, so this one here worked out great. A little bit of pressure here on the trade, but again, do nothing. Just follow the signals, and you were able to close out that trade here June 24. So here's the same expiration. See the end of month June trade. Here's the Condor. Now here's the Dragonfly. And look at this one here. It turned profitable May 28. Like 3 weeks earlier, you were able to close out this trade compared to the Condor. All right, and we'll do a couple others here. And I see some questions coming in. When there's a break in the action here, I'll try to get get some of those questions answered. So here's a March 2020 Condor. So you can see this one here ended up being a losing trade. On March 9, you took your loss and you moved on. And you can automate this, by the way. But I believe this one here gave, yeah, you had an opportunity, a window here one day where this Dragonfly was actually profitable and gave an automated profit-taking signal, which of course can be automated. And I'll show you how to do that in just a second. Now, before I jump over to one other thing here, one other simulation, I want to point out in the presentation 10 minutes ago or so, I talked about some of the bearish strategies. We looked at the half Dragonfly calls, for example. Here are the May week 3 half Dragonfly calls. So let's see what the Theta Trader algorithm has built for us. So here's what this looks like here. We'll go ahead and we'll do 2 of those. Just that simple. But what I really wanted to point out was, go back to the dashboard. We also mentioned the bear hedge strategy. I also want to point out real quickly that you can also buy a Condor. So that can be bullish or bearish. If you buy a Condor, for example, if you think there's a big move coming up or down, you could certainly buy a Condor. It's kind of like a straddle, essentially. So you're actually buying the calls here and buying the puts here and hoping you get a dramatic rally or a dramatic decline. And we looked at the half Dragonfly calls, but here is the bear hedge. So here we'll look at the April end of month. Maybe you have a portfolio of stocks and you're concerned about further sell off, but you don't want to sell everything in your portfolio. Maybe you want to buy some protection. This is a way to do that. So you sell out of the money call spreads, you take the money from that and you buy out of the money put spreads. So if the market continues to drop, of course your put spreads gain in value and the call spreads you sold lose value and you have a nice winning trade. So that's what the bear hedge is all about. It's a directional strategy. We'll go ahead and jump in with, we'll just do 3 of these, for example. In this case, it's a negative 1.25, so that's a credit. You'd be receiving a credit on that trade. So that's what the bear hedge looks like and how easy it is to place in Theta Trader. And what I've done is I've just put up an example of a bear hedge. I don't really remember how this works out, so let's see what happens here. Okay, so you place this bear hedge, and don't worry about the RTI colors at the moment, but essentially what happens is you can see here the market drops, the value of your put spread that you own increases dramatically, and the value of the call spread that you sold loses value, which of course is what you want when you sell a spread. So in this case, you can see how this bear hedge would have worked out during that window of time. Now, jumping back here, you'll notice all of the open positions can be viewed on one page or the dashboard. So right now you're looking at the dashboard, but you can also view them all on one page. So you can see everything at a glance here. These are all your open positions. You can see the color coding all at a glance. And if you want to go back in time, maybe you want to look at this Dragonfly. Well, let's look at this this Condor, the one here, the second one. We'll click on that. Okay, see it's highlighted in gray. So when you scroll down, so this is the history of that particular trade. So in this demo account, I placed that trade on January 10, had 68 days till expiration, and you can see day by day, went a little bit yellow, then it went green again, and the trade is maturing nicely. That theta decay is starting to work, and did get to an orange, but still nothing to do. And it's got 10 days till expiration, so I would expect a signal on that pretty soon. But anyway, just pointing out you can go back in history and look at any trade. And then also you can look at a full page of all your closed positions here. Don't need to really do that right now because I want to jump in and show you this. This is where you go to automate everything. So you go to your account settings and you simply click this risk manager and profit directive. And then everything will be tracked and monitored, and Theta Trader takes care of placing those orders for you whenever the RTI turns blue for a profit or red for too much risk, take your loss and move on. So that's how simple it is to automate this. You'll notice here there's a great help file. We can go into all this, but I wanted to point out the glossary. You can get a description here of the RTI colors. Don't want to go into all of it right now, but it's all right there. Let me also point out we have our proprietary research called Tradescope. So we do technical analysis. This is in-house and for our clients only. So you have access to this. This is, once again, only for us. And this will help inform your decisions on perhaps what types of trades you might want to make. And this is within the Theta Trader platform. It also gets sent out and distributed via email if that's something you'd like as well. And same thing with the daily trading summary. So this is from yesterday. You can see all the quotes from yesterday, give you an idea what's happening in Europe and Asia. And here's looking ahead. Here's some talk about crude oil, some technical support resistance zones, economic calendar. And you can see yesterday we sold some call spreads. So that trade's working out pretty well right now. So again, that's all part of your Theta Trader account. There are also video tutorials. If you think you need a refresher on Theta Trader, that's fine, it's all here. But quite frankly, it's so simple and intuitive, you may not need any help at all. There's education if you want a little refresher on simple option strategies. There's all that available here. And let me go back to the dashboard. And I think what we'll do here is jump into the best feature of all. I think this is absolutely the best feature of all. And give me just a second here, folks. Want to make sure that I didn't forget anything here. I think that's a great review. I think we'll leave the dashboard just as it is because it's really that simple. And if you wanted to ever do a trade simulation, you can see the ones I had preloaded. But that's how you do it here. You just use the calendar, go back in time and select your date, select the strategy that you want to back test and the market, and just that simple. Then you click the button. So just wanted to point out how easy it is to use the trade simulator. It's a lot of fun and it's also very useful and intuitive. But let me show you the best feature of all. Okay, this is something to make it just a bit easier. If you can believe that, it can be even easier. These are trade alerts. And when I say 1 minute, I mean 1 minute or less. One touch responsive alerts where you simply touch accept on the screen or reject on the screen. So you receive this on your smart device, your phone, your iPad, whatever it might be, and everything is displayed on the screen for you. And if you want to accept the alert, it's all you have to do is touch accept because these are integrated with your trading account. These are live alerts, and if you touch accept, our technology places the trade for you. That's all you have to do. So here's an example. You'll receive a text message with the link, and then you just touch the link and it takes you right to the page. So I just want to point out you'll have a graph that you can see. Tells you what the trade is doing, the expiration, your account number, the net premium collected, cash required, and you can't read it maybe, but you'll see the quantity is pre-selected. The trade is already pre-sized for you. Tells you how many days till expiration, your targeted annualized return, everything you need to know. Then you simply touch accept, and that's all you have to do. Now here's the same thing just on an older phone, but it's zoomed in a little better, so maybe you can see. So a perfect example of a Condor, quantity 10. You can see the amount of premium you're collecting, the required margin essentially here, cash required, days till expiration, your targeted annualized return, and then you just touch accept on your screen, and that's it. It's all you have to do. If you don't like it, touch reject. So that's all you need to do. And here's what if you want to go ahead and get some trade alerts now, just enter your 10-digit cell phone, and we need to know the name of the carrier to make this work. And it's only for US numbers at the moment. Sorry about that, folks. But feel free to go ahead and enter that in the questions field. So you can do that. Next few minutes here, give you a second to do that. All right. Very good. So here's the best part of all, folks. How do you get involved? Well, we have a Theta Trader membership. So you receive, of course, the Theta Trader software with our algorithm that creates those option spreads for you. Simple, effective trade selection. So the color-coded RTI will automatically manage those trades for you if that's something you choose to do. That's what we call autopilot, non-emotional trading as much as possible. You saw how to do that with the yellow highlighted there, risk manager and profit directive. And you saw the trade simulator. You saw how much value is in that trade simulator. You can go backwards in time, like a time machine for option spreads. So you have Theta Trades, the RTI, and your trade simulator. That's all part of the Theta Trader package. That yearly value, that software valued at $3,588. And remember, part of Theta Trader is also the trade alert functionality. So these are one-touch alerts integrated with your account. You simply accept or reject. None of this nonsense where you receive an email and then you have to try to copy what someone told you in an email and log into your brokerage account somewhere and try to copy some sort of spread. That's pretty much 25 years outdated, I think. So people love the trade alerts, I can tell you that, and the value on that software over $4,400. And quite frankly, the old cliche is true where someone's at on vacation, they're at the airport, they're literally playing golf, and our clients will say, "Oh yeah, I got that alert. I was teeing off on number 3 or whatever it is." And that's how easy it is. People absolutely lean on and love these trade alerts. So you have Theta Trader software. You have the trade alerts valued total over $8,000, but here's what really makes it different and valuable, much more so than what you can find anywhere else. You have a private coach. So you have someone who's licensed and experienced. You can share, do 1-hour screen sharing sessions or 30-minute or 20-minute, whatever it is you would like. And this co-pilot will work with you, develop your trading plan, your strategy, help explain things, review your history, whatever it is, someone who's licensed and experienced. Value $7,500 and more. I came up with a number based on what I've seen and what people are charging, but quite frankly, I know that people are spending $25,000 or $50,000 on various courses and education. And what we're saying is, yes, it's fine to be educated, but for trading these types of option spreads, we're giving you the tools that you need as part of your Theta Trader membership. So remember, you have the software, and that includes the trade alerts. And then you have a private coach available, valued over $15,500. And then just to get a little bit, what's the word, corny, using the, but wait, there's more line. So yes, remember, you have proprietary research. You have Tradescope and the daily commentary valued over $2,900 for that proprietary research. You have our online video tutorials that we make available. That's all part of the package, of course. So to summarize, Theta Trader membership includes everything you see there on the screen. The Theta Trader, the Theta Trades, the trade alerts, the private coaching, the research, over $18,500 value. And I think I mentioned earlier, we used to do these presentations in-person events and so forth and conferences. We would make this available to people in the audience for, actually it was $4,000. So that number could be 4,000, but oftentimes what we would do during the live events as well is, maybe at the time people could have maybe a short one-on-one meeting with us and so forth. But what we've done, of course, is we've moved that all online. And that's why I mentioned that earlier with the coaching. So remember, your Theta Trader membership includes everything we talked about. And because it's all internet-based now with these presentations, we can offer it to you at a much, much more, let's just call it a value-oriented price. So we have a special 80% off our retail pricing, and we do these live presentations, and we try to make these discounts available during the live presentations for a limited period of time. So it's not something that's available on the website or anything at this price. So it's only one payment of $597, and that's one time. So people ask, well, is that quarterly? Is that yearly? Is it, no, one-time payment, lifetime membership. We've been trading since 1997, and there is the link to make that happen. cf.altivest.com/TT, and there's my direct phone number. So if you call right now, I believe I have it set up for voicemail or forwarded, I can't remember, but either way, you can call right now and we'll be able to answer any questions one way or another, or leave a message, we'll get back to you. But do write that number down, write that link down. And there's no excuse, folks. You have a 30-day guarantee on that membership fee. So even if you're just a little bit on the fence, sign up anyway. And if it turns out it's not for you, not a good fit for some reason, that's fine. We just refund that membership fee. And we do make this a limited time offer, that discounted $597, and it does expire tomorrow evening, I believe. So it gives you some time to call us or email us or ask about any questions you might have in mind. So a few FAQs. Tax efficiency. You can lower your tax rate by about 10% because futures and options are tax efficient. If you're trading individual stocks, in this example, $100,000, 20% return, and you're in the highest tax bracket, you're going to pay $7,400 in tax. That's a 12.6 return. Now, if you're doing futures options like we do, they're tax efficient. So you have a different treatment of your gains. 60% of the gains are taxed at the shorter term, or the capital gains tax rate, which of course is less than your individual tax rate. So the ultimate result here is you save over $2,000 in taxes simply because you're trading in a tax efficient market. That's a huge advantage, folks. Big, big difference. I see a lot of questions coming in. I think I'm going to get to probably answer those here. And there's no more itemizing each trade. You just have a 1099 with your P&L, and you just plug that into your taxes. That's all you have to do. So you can do an IRA, yes. There might be some financial or experience requirements, so ask us about those details. So you can use alternative assets, such as what we're doing in a self-directed IRA. Absolutely. And why just the E-minis? Why the S&P 500? Why? Well, they're liquid, they're efficient, they're cost effective, and here's an oxymoron for you. Mini can be huge. The E-mini S&P 500 outtrades all ETFs around the globe by 2.5 times. So that's amazing. So even the SPY, everyone thinks that's where all the activity is. No, it's in the E-minis. The E-mini trades over 10 times more average daily dollar volume compared to the SPY. So this is where the action is. This is where the institutions trade and the professionals are trading, in the E-minis. So those options have, once again, volume, liquidity, access. You get superior execution. That's the advantage. They have a cost savings of $4 to $15 per contract compared to SPX options. So that just means you have those tight bid offer spreads. And here's a big deal, folks, just to pause 1 second. When we're trading these E-mini spreads that you saw in the demo, especially with the Dragonflies, and they have 6 different legs, Theta Trader places that as one order at one price. It's called an object. So those 6 legs together are packaged as one order at one price. Now, if you're trying to do a Dragonfly with stocks, you can't do it as one order at one price. You have to break it up into 2 different trades, 2 different orders, leg in, and then try to leg out and monitor it and track it separately. It's just a complete mess. It's ridiculous. I've tried it. I've seen other people try it. And if someone knows different, let me know. But it's not possible. And I think it's just really the infrastructure of securities versus the future side of things. They're two different worlds. They don't overlap at all. So that's a huge advantage. And of course, the ES options have the largest market share. So you have all the strike prices you need, 100 annual expirations, you have granularity and coverage. And here's what I'm talking about. So when our algorithm is looking for the strike prices to build out those dragonflies or condors, it's going to find them because they exist in the ES or the NQ or RTY, so the E-mini family. But that's not always the case. Other than maybe a handful of the most heavily traded stocks, if you're going deep out of the money and far out of the money looking for strikes that you need to build these spreads, you're not probably going to find them. And so, you can see here's a condor with calls and puts, and then some time goes by, and then the algo generates another condor with some puts and calls at different strikes. More time goes by, and then you see another trade here with puts and calls. So as the algorithm is looking and searching day by day, it's finding what it needs to build these trades. And here's a big advantage too. If you're trading just the E-minis with us, you're following just, a couple markets, not thousands. And the margin use is very efficient versus stocks. And then a clear cost structure. I'm going to show you just a second here. Remember, these are not securities options. Nothing is hidden. I'm going to get to the cost in just a second. But with the E-minis, they all trade at the CME Group, the largest futures exchange in the world. And they all trade on the Globex. That's their electronic exchange. So every order, if you're doing a 1 lot or 1,000, every order goes through Globex, and that's where it's filled and executed, large or small, equal treatment for every order. So there's no payment for order flow. I call it nonsense. But so if you're trading stocks, and we all do, but keep in mind, the brokerage you're placing the order through is just a front end. They're not actually filling the order. That's called basically the payment for order flow. So even though they say they're commission free, look at this, Robinhood orders were executed at prices inferior to other brokers. And the reason why is they sell your order flow. So you place an order with Robinhood or whatever other big box brokerage firm, and they say they're commission free. Your order is then filled by a third party market maker, in a nanosecond, of course, but it's still being filled by a third party market maker. And that third party is paying Robinhood for that order flow, they call it. And why are they doing that? Why do they want to fill your order? Well, because they're exploiting your orders. They're shaving money off of the spread. It says here, markets are harmed by the payment for order flow practice, increasing the cost to trade for everyone. Retail traders not getting the best possible price. Payment for order flow is disguised commissions. If you want the broker to work for you, pay a commission. This is a great quote here. Save a penny, lose a nickel. Robinhood got fined $65 million. SEC is probably going to come down on that whole thing about free commissions. It's not free, folks. And this guy here summed it up. Nothing of value is truly ever free. So here's the question, what are the rates that we charge? Well, first of all, I should have pointed out that everything I showed you in Theta Trader is net of all commission, but our rates are competitive. They're at 5.25, and that's round turn, and that's all in. That includes everything. Now, you might think, well, gee, I see rates that are lower than that. Well, here's an example. I just took a screenshot right here, big box brokerage firm, just a couple months ago, and they say, well, our rates are 2.25. Okay, well, that's per side. And then they have more fees on top of that they don't list, but there are clearing and exchange fees that go on top of each side of the trade. So it ends up being higher than what we charge. So our rates are competitive. And our performance, people say, well, what's your performance? Well, we're a brokerage firm and everyone trades differently. So everyone accepts different orders at different times or changes prices. Everyone's self-directed, making their own trading decisions. And again, everything in Theta Trader is net of all trading cost. What size of an account? We recommend a minimum of 25,000 because you want to be able to do different option spreads at different times. If you do 50,000 or more, here's the good news, and people love to take us up on this offer. It's free. We rebate the account. I'm sorry, we rebate the membership fee. So what you would do is you would sign up and you fill out the form for the membership, and then you open your account. You get your account funded with 50,000 or more, and then we'll just simply rebate that membership fee to you. So people love to take us up on that, and certainly people have 6-figure, 7-figure accounts. It's just whatever is suitable for you. Trading account types: IRA, individual, joint, corporate, LLC, trust, all the above. And just to kind of summarize, why would you even bother doing this with alternatives? Keep in mind, this is an alternative investment approach. Well, here's the benefit. They have a low correlation to traditional investments, so that may improve diversification and lower your portfolio risk. So that's really the key to all this, folks. And also keep in mind, the Federal Reserve is fueling asset price inflation. Here's the Crb Index here, Commodity Research Bureau Index, and that's just an index of all commodity prices, kind of an aggregate, with energy being a large part of it. But this is the problem. That little inflation finger is pulling money out of your pocket silently every day. So you can't just sit tight and do nothing. Inflation's everywhere, as the Wall Street Journal says. And here's a really interesting thing too. This will kind of help give a little more context. I'll point it out in just a second. Well, here again too, this is pretty obvious, but the Federal Reserve is kind of taking their foot off the pedal here and starting to tighten. So they call it the sugar rush, will start to fade. But look at this here, the 10-year stock market return looking forward. This is just from a few months back here. I thought this was interesting. Americans have a high allocation to equities, and that is a contrarian indicator, suggesting weak returns. And what they're talking about is there's a statistic known as R squared. If all you remember that from school, I remember that, but don't ask me to explain it right now. The indicator since 1951 has been able to predict 70% of the changes in the stock market's 10-year return. So this one indicator has a pretty good, I guess you could say, forecasting measure, is a forecasting measure, and it's projecting the S&P will produce a total real return of minus 4.2% in the next decade. You've got Bill Gross saying surging inflation is going to topple stocks. You've got unrealistic expectations. This is interesting. The average U.S. retail investor expects 17.5% forward returns. And look at this here. In December of 1999, the average investor expected a 19% annual return. And guess what happened from 1999 to 2009? Negative 2.3%. So expectations here are way overblown by the average retail investor. Even financial advisors think something like 6% is more realistic, and that even might be too high. So that's why we like what we're doing now. In particular, you've got this low correlation to traditional assets. It's not correlated to any benchmark. You can have non-directional strategies. You can take a bias any one way or another. And then here's an interesting piece here, and I want to point this out, and then we'll wrap up. I think I can get to a few more questions here. I have time if you do too, so thanks for joining me. I set aside a couple hours for this, but you want to avoid market drawdowns. I'm gonna state the obvious, but when you see it on a graph, this is you have this here period 8 months where we're down 26%. You have 4 months we're down 25%. 2 months where you're down 28%. That was from 2000 to 2003, the tech crash. So here's the NASDAQ. It gave up 83% from top to bottom. So here you are, drop, drop, drop. And by the end of it all, it had dropped 83%, even though there were 2 big rallies of over 50% during that time. So you're going to have these big sell-offs. They just happen, and you're going to have these counter trend big rallies at times too, where everyone gets sucked back in, and then it just collapses again. But here's the thing here. How do you sidestep a bear market? Well, here's the S&P over the last 30 years, and I'll show you here in a minute. The red sections are the 1 year periods of time where the S&P was negative. And there were only 2 prolonged bear markets in the last 30 years. So here they are. This red section here and this red section here. You can see here clearly red and price declines in the bear market. Now, it says here 4.5 years were spent in those 2 bear markets. However, a third of the period, investors had spent over a third of that period recovering from those losses. So it took 6 years after the tech crash and 5 years after the financial crisis to regain prior highs. So that's the whole idea, is to try to avoid these big drawdowns. I mean, I think people sometimes forget this, but if you're sitting on a 30% drawdown on your account, you need to generate a 43% return just to get back to where you were. Or even worse, here's a 40% loss. Now you have to get back up to 67% gain to break even. And of course, if you're down 50%, you have $100,000 and it's down to 50,000 now. Well, how do you get back up to 100,000? Well, you have to double it, or you need 100% return. So that's why you want to avoid those drawdowns. We think something like Theta Trader and the strategies within Theta Trader can help you do that. So you don't want to be typically in 100% stocks, or even that whole stocks and bonds thing. That's not really diversified, folks. We think alternatives, such as what we're doing, should have a part in your portfolio. So we like the Theta Trader approach. Remember, pre-selected trades with spreads, automated trade exits, you have that RTI taking profits and losses. You have those integrated one-touch trade alerts. You have someone to help you along the way with a personal coach. We think it's a process-driven approach to using automation and having access to strategies for up and down, sideways conditions. So quite simply, there are 5 steps to get started. You just complete the order form here. Then you'll get your Theta Trader login credentials. You'll receive an email with your account opening link and sort of your onboarding instructions. Then once your account is opened, we'll get you instructions on how to fund the account. You'll send a bank wire or an ACH, and then you'll begin trading. So we'll leave that up for now. And that's at the end of the presentation. I think I have a few. Let's see if there's a couple other. Let me put that in here. I'm just typing in the link there. So cf.altivest.com/TT. That's your link. And let me take a look if there's questions I wasn't able to get to. I saw a lot of questions coming in. Okay, I see them coming in now. Just a second, folks. If you asked a question, just give me a second. I'll do my best here. Just having trouble expanding my screen. Okay, yeah, someone asked if this is being recorded. The answer is yes. Uh, 2020 examples. I'm not sure what the question is there. We can use any example you want. You're free to do a demo if you'd like. You can run through the back testing and simulation on your own. So that's something you can do on your own if you'd like. Yeah, the size of account, we suggest a minimum of 25,000. Okay, and Let's take a look here. I already covered the commissions. Yep, that's already covered. Someone wants to know, I don't know what that means, data, past results data. Well, you would use the trade simulator for that, go backwards in time. And again, when you say past results, results of what? I mean, every client trades differently. It's like asking the results for E-Trade. What are E-Trade's results? Well, they're a brokerage firm and everyone trades differently. Take a look here. Yeah, $50,000 is a good amount to start with. Again, it's up to you, whatever risk capital you feel you're comfortable with. Some people want to start with a lot more. Some people, maybe you can do 25,000. And yes, you will receive a link to the recorded webinar. That's correct. And yep, we're trading futures and futures options. That's correct. And with all the advantages. And let's take a look here. Someone's asking about different languages. Unfortunately, we don't have any multilingual people on the team. But a lot of times the trade alerts are really all that's needed. I think kind of numbers kind of speak for themselves. And of course, let's see. But someone's asking about average results for your, well, again, there's no such thing as that. We can't, unless every client has the same result, it doesn't work like that. So I'm not sure what the question is. Someone wants average results. There's no such thing. We're not managing the money. Every client makes their own decisions, uses the tools differently. So everyone's result is different. And on that note too, I get why you're asking, but keep in mind when you're on the internet and you're receiving advertisements on social media, or you're receiving emails and text alerts, and you're viewing webinars from lots of people about trading, 99% of those people are not in a regulated industry. They're just people selling a subscription to some sort of trading service or newsletter. And they can, quite frankly, say whatever they want, and they can show you whatever they want. There's no oversight. There's no auditing of anything they say or do. We're different. We're a brokerage firm. We're heavily regulated. We're always audited. And we've been doing this. I've been doing this for over 30 years in AltaVest since 1997. So we know what we're talking about, and we know what we're doing when it comes to doing things right and in compliance. So hopefully that helps answer the questions. Your maximum risk. Well, if you're doing a Condor, your maximum risk is essentially the difference between the two strikes on any one side. So it's really, in the case of the example that we saw in the simulations or even on the dashboard, you're going to have a 20-point spread between the sold and bought position. So 20 points on the E-mini S&P 500 is $1,000. So your risk is $1,000 minus the premium received and your commission. So, it might be a total maximum risk of, let's just say, $850 for that Condor, for example. Hopefully that answers that question. And that's really the cash required. So the cash required is the maximum risk. So that's why there's no margin calls. You're putting up the maximum risk in advance to hold that position. And someone added their number. Thank you, thank you, thank you. Yeah, lots of good questions. Thank you so much for all that. And let's see, I have another one coming in. Okay, yeah, and you see the link there in the chat, cf.altavest.com/TT. So simply go to that page and you can get yourself signed up. And of course, you can give us a ring as well. You see my phone number there. send me, you can also send me an email directly. You can use info. That's not as direct as Erik, E-R-I-K, at altavest.com. All right, well, very good. I think we've gone through the questions and then some, and I've probably kept you here long enough. So thank you for your time, and I look forward to working with you. And I can tell you that people in particular love using the trade alert functionality, and the idea that this is something so unique and different from their current trading landscape. They have, probably like you do too, you're doing stocks and you're trying to read newsletters and watch the hot picks, and there's 10 different gurus that you might be wanting to follow. That can be overwhelming. It might be nice to consolidate and do something that moves a little bit slower as well. Keep in mind, this is not a high velocity type of strategy with selling premium. You're looking for theta decay to work, and you're looking for those trades to mature slowly over time. So that's kind of nice, where you can have kind of something where you're not screen watching, you don't have to babysit, and Theta Trader can do a lot of that work for you by monitoring and submitting your orders to close out trades. So very good. Thank you everyone, and have a great rest of the day. We'll call it a day for now and look forward to hearing from you. Bye-bye.